the next trillion-dollar stock. In August 2018, Apple was the first ever company to surpass the trillion-dollar threshold. Till now, there are still only 5 companies that are worth more than $1 trillion. But hold on, I believe that this stock that I'm going to show you will be the next one in line. Up till 2019, I was mainly invested in the US and Europe. While I also had an ETF for emerging markets, I was never fully convinced that those companies would outperform the US markets. However, now, since COVID-19, I'm starting to get more and more bullish on China. If you look at how quickly China was able to financially recover from this crisis, I only expect China to outperform the Western markets in 2021. Let's take a look at this graph. It represents the economic growth of China in 2020. You can clearly see that there was a setback in the first quarter of 2020 due to COVID. But as soon as the second quarter of 2020, China's economy was growing again on a year-to-year basis. This means that between July and September, the Chinese economy grew by almost 4.9% compared to that same period last year, which is incredible. While China is returning back to normal, we, in Europe and the United States, are facing yet another lockdown, waiting for vaccines to be distributed. This will only foster the outperformance of the Chinese economy, in my opinion. If you are thinking about China, the first name that should come to your mind is Alibaba, with the ticker symbol BABA. I decided to do some homework on this company and went down an extensive rabbit hole which turned into buying a massive amount of shares a few hours prior to posting this video. I am planning to add more shares to my position in BABA over time, and I believe this company will be the next trillion-dollar company. But first, may I please ask you to like the video if you enjoy the content and subscribe to my channel so you won't miss any stocks that I will cover in the future. I would really appreciate it, and it also helps the channel grow. Now, let's dig further into my analysis right after this short intro. Except for being the Chinese equivalent of Amazon, you probably really don't know much about BABA. So before you decide to invest, I want you to get an understanding of how BABA makes money. BABA's goal is to create value for society and find solutions to alleviate challenges. BABA also looks to convert their resources into a pathway to help small and medium-sized businesses become more profitable. Not only by being a platform on which suppliers can sell their products, but also by using artificial intelligence and making use of this data to suggest your products to the right customers. In short, BABA provides a technology, infrastructure, and marketing tools which allow businesses of all sizes the opportunity to engage with their customers and users in a seamless manner. If you want to have a diversified portfolio, Alibaba is all you need. They have their hands in many different business segments, which include core commerce, digital media and entertainment, innovative initiatives, marketing services, and payment and financial services. Alibaba is actually a holding company. The holding is split up in many other companies, which are, for example, Taobao, which has become China's largest mobile e-commerce platform as of 2020. On the other hand, you have Tmall, which was launched in 2008 and has become the world's largest third-party online and mobile commerce platform for brands and retailers. On the wholesale side, BABA's original business, Alibaba.com, was China's largest international online wholesale marketplace in 2019. Alibaba.com connects Chinese and overseas suppliers to wholesale buyers overseas. And of course, everyone knows this one, AliExpress. AliExpress is actually the B2C site of Alibaba.com. It has grown to an established global marketplace where suppliers can sell directly to their customer. BABA has also been solidifying its foothold in the payment and financial services infrastructure through an equity interest in the Ant Group. The Ant Group is the parent company of Alipay, which you could compare with, for example, Apple Pay, and develops open platforms for technology-based financial services. The main drivers of their financial services include wealth management, microfinancing, and insurance. During last fiscal year, Ant Group reached 1.3 billion users which is roughly 16% of the global population. Baba is holding a 33% stake in the Ant Group and was recently valued at between $350 and $450 billion. Also, on the strategic side, Baba is acquiring other companies, such as Ele.me, to create synergies in other parts of their business. Ele.me is an on-demand delivery and local service platform throughout China. Ele.me's on-demand delivery network creates valuable synergies throughout Baba's digital economy and for their platforms such as Freshippo, Alipay, Taobao, and so on. Ele.me is also active in the food delivery business and increased its paying customers by 45% last year. And looking at the recent IPO of DoorDash, this also looks to me like an attractive industry to be in right now. At its first day, DoorDash rose 86% above its IPO price, being valued at $60 billion. I kept the most promising industry last, cloud computing, which has become one of the hottest sectors over the past 5 years. And with Alibaba Cloud, Baba is now the world's third largest and Asia Pacific's largest infrastructure as a service provider by revenue as of 2019. Again, using the cloud computing, Baba can facilitate its customers with artificial intelligence to get to know their customer better and augment the sales for their suppliers. Their business model is as robust as it could be. In short, it's safe to say Baba is operating in many of the hot sectors. And with China having the largest population globally and a growing GDP, it makes sense to me for Baba to continue its track record of growth as it is a leader in many of tomorrow's critical business segments. Now let's move over to the financials. After I did my homework to have a better understanding on Baba's business model, rather than just saying it's a Chinese Amazon, I dug into their financials, and I love what I see. I'll first provide you with some key figures. In Baba's most recent quarter, they grew their revenue by 30% year over year. Its free cash flow increased by 33% year over year and was about 24% of its total revenue, which are incredible figures. The cloud computing revenue grew by 60% year over year. At Amazon, this is currently the most profitable business, while at Baba, this is still a loss-making segment. However, their CEO said on the earnings call that, and I quote, "We can definitely expect to see profitability in the following 2 quarters." Alibaba's cloud growth rate is also outpacing Amazon and Microsoft with a growth rate of 29% and 84% respectively. And on top of that, Baba is also close to having over 1 billion active users on their platforms. On Singles Day, which could be compared with what Black Friday is in the US, Alibaba sales broke new records. With more than $74 billion in sales, Baba almost doubled its revenue record of last year. Seeing that there is continuous data to support positive growth trends in both an annual as well as a quarterly basis, I don't think it would be incorrect to speculate that these trends will continue. These double-digit gains in each category demonstrate the strength of Alibaba's businesses. The positive momentum can continue for the foreseeable future with strong growth for cloud and e-commerce markets. According to the following sources, the global cloud computing market is expected to increase by 17.5% annually to 2025. Then, the global B2C e-commerce market is expected to grow at an 11.7% growth rate annually to 2025. And finally, the global B2B e-commerce market is expected to grow at 17.5% annually to 2027. Alibaba participates in all of these industries, and with its business model being vertically integrated and having synergies from all of its businesses, the company has a good chance of growing its piece of the pie going forward. I even consider these numbers to be conservative for Baba. In China, only 64.5% of the population currently has access to the internet. With that number increasing year by year, China will be the big winner of e-commerce. According to analysts, Alibaba is expected to achieve 39% earnings growth for FY21, which ends in March 2021. And on top of that, the company is expected to average 23 to 24% earnings growth over the next 5 fiscal years. This strong growth is likely to drive the stock to outperform the S&P 500 over the next 5 years. To put everything into perspective, the S&P 500 is expected to achieve an earnings growth of about 12% annually over the next 3 to 5 years. So Alibaba stock might double the broader market's gains. In the near term, Alibaba's earnings per share estimates were increased over the past 3 months from $9.31 to $10.36 for FY21. Earnings per share's estimates were also increased from $11.63 to $12.5 for FY22. These increases should help provide some near-term positive momentum for the stock. The earnings growth over time should help drive the stock higher if these estimates are met or exceeded. If you aim to outperform the S&P 500, you have to invest in companies that have above average growth. Alibaba is one of those companies with the potential to sustain above average growth for many years. Now, let's try to do a relative valuation. Investors might look at Alibaba's trailing PE of 35.3 and forward PE of 20.2 and think that the stock is overvalued. However, the metric that holds the most weight for a company with sustainable high growth is the PEG ratio. The PEG ratio takes multiple years of future growth into account and divides the PE ratio by the 5-year earnings growth rate. Alibaba is currently trading at a PEG ratio of 0.87. This factors in Alibaba's earnings growth for the next 5 years. Most growth stocks have a PEG ratio between 1 and 2, and with Alibaba having a PEG ratio of less than 1, it means that the stock is currently undervalued. Just a few weeks ago, Alibaba's PEG was still 1.49. Since the stock dropped recently, it is now attractively valued to me. Alibaba has strong margins as a result of how the company is structured. As mentioned before, the company is typically considered as the Amazon of China. However, these companies are structured differently. Yes, you're right, both have similar cloud businesses. However, Alibaba is more platform-based as compared to Amazon for the e-commerce business. Amazon has many fulfillment centers and must invest a lot of money to build and operate these facilities. Thus, Amazon has higher expenses. Alibaba, on the other hand, does not have this burden, as the company primarily connects manufacturers, buyers, and sellers via its online platforms. The difference in business structure shows up in the margins. Alibaba's net income margin is 22.55% as compared to Amazon's net income margin of only 5%. Alibaba's gross margin of 43.8% is also higher than Amazon's gross margin of 40%. While we are comparing Baba and Amazon with each other, just have a look at the historical PE ratios of both companies. Amazon is way more expensively valued than Baba does. In the last year alone, Amazon's PE ratio was on average 4 times as high than that of Baba. Also, looking at their profitability, Baba has been always more profitable than Amazon is. While Amazon's revenues are up to 4 times higher, it still struggles to be efficient and generating earnings growth, which what we as investors eventually want. Just imagine what those profit margins will look like in a couple of years when Baba's cloud business will become profitable. There's a big upfront investment needed for cloud services, but once it is up and running, earnings growth will be exponentially. Alright, now that we covered everything, let's move over to the conclusion. Alibaba demonstrated that it can sustain strong above average growth over multiple years. The company has a good chance of continuing this strong growth due to the expected market growth for cloud and e-commerce. Alibaba is an established go-to company for cloud services, B2B and B2C offerings, and is likely to build on its success over at least the next 5 years. The stock is attractively valued based on the PEG ratio, with room to move higher on further growth. Alibaba's above average revenue and earnings growth can help drive the stock to achieve increases that exceed the S&P 500's gains. Baba stock recently dropped by more than 20% after the Ant Group IPO was halted. But in the meantime, they also announced its record-breaking Singles Day sales, which could only support the stock once they report their quarterly figures. To me, this is the perfect opportunity to build up my position for the long term. Analysts also have an average 1-year price target of $339.15 for the stock, which represents a gain of more than 30% from the current price. That, to me, looks like it can be easily attained with revenue growth expectations of 28% and earning growth expectations of 21% for FY22. That rate of revenue and earnings growth can drive the stock to easily hit the target from the current attractive valuation level. If you want me to cover more stocks, please leave a comment below and let me know which stocks you want to see next. Also, don't forget to like the video and subscribe to my channel. See you in the next one.